This video is being produced in the spring of 2024. We've been through some rough renewals on condos, co-ops, apartment buildings, and HOAs over the past several months. Premiums are up, availability of coverage is down, and the marketplace looks like it's going to be like this for a while due to the catastrophic losses countrywide and an overall restrictive appetite for property insurance by major insurers. For property managers, this is a particularly challenging time to negotiate renewals that are blowing up budgets and creating a lot of extra work and a lot of headaches. You may be thinking there's got to be a better way, and there may be, which I'm going to discuss in just a minute. Hi, I'm Gordon Coyle. Welcome to my channel where we talk about the risk and insurance issues on the minds of business owners. As an expert business insurance broker, these videos are intended to help guide and educate decision makers to help make you a more informed insurance buyer. If I don't answer the question on your mind that brought you to this video, reach out and let's connect. I'd love to hear from you. So, for those property managers frustrated by increasing insurance premiums and difficult renewals, what sort of a solution can be created? Right now, we think a solution to this problem is to take the buying power a property manager has among all the properties they manage and deploy a captive insurance arrangement. Now you may be asking, what is a captive insurance arrangement? A captive is a mini insurance company you can create to collect premiums and pay claims and operate like a regular insurance company. Most of the administrative tasks are delegated to special captive managers and third-party administrators, so you don't get bogged down in the daily operations of the company. At the end of the policy year, if there's a surplus of dollars left from the premiums after paying the claims and the operating expenses, the remaining profit can be distributed to the captive owner, the property manager. That is a very basic outline of how a captive works, but it should give you a good idea of how it functions. For a captive arrangement to work, there needs to be about $500,000 of aggregated premium going into the plan, and the loss ratio for all the properties needs to be around 40% or less. Now, what's a loss ratio? In the aggregate, a loss ratio is a 5-year average of the dollars paid out in claims by the insurance companies covering these properties you manage, divided by the premiums paid for the same period. As I mentioned, we like to see an average loss ratio of 40% or better. Here's an example of what I'm talking about. Say, for example, you manage 25 properties that collectively pay $1 million a year in premiums. That's $5 million over 5 years, easy math. Now say that the insurance companies on those properties paid out less than $2 million in claims over 5 years. Divide 2 million by 5 million, and that would result in a 40% loss ratio. In the traditional insurance world, the best managed properties that don't have claims return significant properties back to the insurance company year after year. In a captive arrangement that I'm talking about, those profits go back to the owner of the captive, the property manager. The better the loss ratio or the less dollars spent on claims, the greater the profit potential. There are 2 additional features to a captive that work well for property managers. The first one is that it's a marketing tool to bring in new properties. With the current disruption in the insurance marketplace, the stability and competitive pricing a captive can offer is an attractive alternative to board members looking for options. And the second thing is retention. A captive stable pricing and ease of renewals can help retain properties that have been stung in the past by big premium increases and the arduous renewal process. Client properties in the captive will enjoy the benefits of this arrangement and practically loathe going back to the traditional insurance process, thereby improving your client retention. Now, a word of caution. There is downside risk that claims can get out of control, and even though you're protected by capping maximum payouts, there's always a chance of having down years and not making any profits. But that's business. To reap rewards in good years, you've got to accept some risk for bad years. The key is hedging that risk with proper captive structure. How do you get started or know if this is a viable option? It starts with a conversation and then taking a look at the data to see if a captive is feasible or not. If you want to take that first step, why not reach out and connect? I'll take down some basic information, and if it makes sense, we'll arrange a call with our captive specialists. There's no cost or obligation to take this first step. So if you or your properties are experiencing a lot of pain around insurance, and I know a lot of them are, it probably makes sense to chat. My contact info is in the description box below, and I'd love to hear from you. Hey, and if you found this content helpful and interesting, do me a favor and hit that like button. Thanks.